You are emotional, and so am I. So in trading, we need our entry model to be simple yet super effective. And this can be achieved through using fair value gaps. Now, the reason we need our entry to be simple is because it's the most emotional part in our trading. And when we get more emotional, we are more susceptible. The risk is higher that we are about to mess up, that we are doing something that we should not be doing. So our entry model should guide us through it, should be a step-by-step manner. But the simplicity should not come at the cost of the effectiveness. It should still be good and still be very effective. And that is exactly where the fair value gaps come in as well. So there's 4 steps that I want to go over. Where the first step is PD array, because we need to understand how we align the time frames. Then the second step is fair value gap in. Third step is fair value gap out. The fourth step is entry variation, because we are working with either a bag or an FVG. And I'll explain to you later on when we get to the fourth step what I mean with that. All right, we have arrived right here on Bitcoin. And I first want to go over Bitcoin. And the further we move along in this video, the lower we are going to go in time frames. Meaning eventually we are going to look at scalping and day trading. Because all of this is fractal. And it's the first thing I need you to understand. All of this is fractal. And what I mean by that is that we are currently looking at the daily time frame. But it's purely that at the top left, it says the D right there, and that it actually says that this is the daily time frame. Because if I were to open this chart and I were to show you this chart, then this could very well be the 1 minute time frame, and we would not know. Because every time frame looks the exact same, and every time frame acts in the exact same manner as well. So the entry model that we are going to go over is the exact same on every single time frame. But it is our job to align those time frames. And what I mean by that, the further the distance between 2 time frames, the more confirmation you are going to need on your entry pattern time frame. So what does that look like? Well, here we have a weekly fair value gap sitting right there, which we can continue higher off of right there. Targeting eventually these highs right there, and potentially even we're getting close to all-time highs. Very interesting. But now we have the PD array, the first step. And now we need to determine which time frame are we actually going to go into to look at our entry pattern. And this is where, again, the further the distance between your PD array time frame and your entry pattern time frame, the more confirmation you are going to need. So for example, if I was to go into the daily time frame right there, I don't need a lot of confirmation. I could just need a fair value gap higher. That's all I need. But if I were to go into the 1 minute, I need a lot of confirmation, because a single 1 minute fair value gap coming off of the weekly fair value gap right there is simply not enough. It's not strong enough. It doesn't show the actual intention of what price wants to do right there. So if we do dive into the daily time frame right here, then what we see is the second step. And the second step was a fair value gap in. So this might seem scary at first, because whenever we talk about a PD array that we might continue higher from, and we talk about our entry pattern, then I always mention I would want to see a fair value gap coming into my PD array as the first part of my actual entry pattern, because that shows manipulation. A lot of people right there get tricked into thinking it is going lower. And when they get tricked into thinking it is going lower, opposite liquidity can enter the market right there in the form of buys, where banks, big institutions, etc., as crypto likes to refer to whales, can enter a trade because they are met with opposing liquidity in the form of sellers, because every seller needs to have a buyer and every buyer needs to have a seller. So the second step after the PD array is fair value gap in. A fair value gap in right there is again the first part of our entry model. Then after we have that fair value gap in, it is depending on how that fair value gap acts, which is also quite important. Now right here, we see that on this up candle right there, we have a rejection off of that fair value gap right there. The next candle is a down candle sitting right there, which tries to follow through lower, but it fails to do so, indicating that this fair value gap was not strong enough to create a new fair value gap lower. Perfect. After that, what we need is the third step, a fair value gap out. And what I mean by that is fair value gap into the PD array and fair value gap out of the PD array. This creates, as we know it, a sharp turn, where once this daily fair value gap right there has been confirmed, so the third candle right there closes, this is a confirmed fair value gap, this is a confirmed sharp turn. Now, this is quite simple to understand, I imagine. And recently, when Bitcoin was actually around here, I tweeted this, the following. And I mentioned on Bitcoin right there that you would not want to enter on that fair value gap right there. And this is where the fourth step comes in. This is where the entry variation comes in, where we need to understand if this fair value gap right there that is coming out of the PD array, so the third step, the fair value gap out, is that a breakaway gap, so a bag, or is that an FVG, a fair value gap? And if we want to understand a breakaway gap, then there's two ways of knowing if it is a breakaway gap. And the first one I'm going to show you right here. If we look at the discount arrays that are currently in price action right there, then the first discount array that we actually encounter, so the first support area that we see, is this breaker right there. That's a breaker block. And that breaker block right there is higher than the fair value gap itself. And when we have a discount array right there above this fair value gap, that discount array could withhold price from trading into the fair value gap, meaning that there's potentially a breakaway gap. And when there is potentially a breakaway gap, we do not want to enter on it. We want to be certain that it isn't a breakaway gap, because otherwise we might be waiting all this time and then we miss the entry because we simply did not get involved. That's going to hurt and that's going to cost us money. So the first way of knowing if it is a breakaway gap right there is by knowing if there is a discount array above the fair value gap that you are about to enter on. If there is, then your entry is on that first discount array and not on the fair value gap. You do not necessarily need to cover the swing lows. You can cover the bodies right there, targeting a 1 to 2. And this is the exact example right there that I had in my tweet, because that breaker might be responsible for the fair value gap not being traded into. And that might be is enough for us to enter off the breaker instead of the fair value gap. I would rather want to be a part of the move right there instead of missing it and waiting another decade before we have a new trade. Of course, that's me over exaggerating, but that's my thought process. I just want to be a part of the move. This is the first entry model that we have sitting right there. And this is the first variation of an entry model as well. All right, we have arrived at example 2 right here, USDJPY. And the first step here is of course also PD array. Now the first step is the only thing where you need to think, what do you want to do right there? How do you want to align those timeframes? Again, general rule of thumb is that if you have a monthly PD array, you want to focus on either a 4-hour or a daily entry pattern. If you have a weekly PD array, it's going to be the 1 hour or the 4 hour, daily going to be the 15-minute or the 1 hour, the 4 hour is going to be the 5-minute or the 15-minute, 1 hour is going to be the 1 minute or the 5 minute, 15 minutes is going to be the 1 minute, ideally, and if you want to, you can also use the 5 minute, but the 1 minute is enough. I'm giving you two options right there, because if we, for example, use a monthly PD array and we can go either into the 4 hour or the daily, we need to understand the 4 hour is the minimum, where the 4 hour, the lower one that I suggest, is where you need more confirmation. The higher you go above the 4 hour, the less confirmation you need. And the example we had on Bitcoin was weekly to daily. The higher you go is perfectly fine. So if you want to use a 1 hour PD array and a 15-minute fair value gap higher only, that's perfectly fine, because the smaller the difference between those time frames, the stronger the confirmation is going to be. Where of a weekly PD array, a daily entry, a daily fair value gap higher is extremely strong, like we saw on Bitcoin. But don't go lower than the lower time frame I suggested. So for the monthly, it's the 4 hour, weekly 1 hour, daily 15-minute, 4 hour, 5 minute, 1 hour, 1 minute, because then it becomes extremely dangerous, because that confirmation is going to be quite difficult. So here in the 1 hour, we see we are almost reaching these highs right there, which we can of course reach by coming into this 1 hour fair value gap right there to continue higher off of that. Here we choose 1 minute or the 5 minute. Which one do you want to enter off of? With the minimum being the 1 minute again. For this example, I'm going to go into the 5 minute. Now on the 5 minute, we are seeing again a fair value gap in right there, which is the second step. Fair value gap in. Absolutely perfect, beautiful fair value gap into the PD ray. After that, we see again a fair value gap out right there. This fair value gap right here not following through, like we're seeing, not creating a new fair value gap lower right there, of course, is a nice extra detail because that actually shows us that this bearish fair value gap was too weak to follow through right there. And then after creating a bullish fair value gap indicates that the bullishness, the bullish intention is taking over. The bullish side is stronger. So step 1, 2, and 3 are complete. This is again where the variation, the entry variation, step 4 comes in. This is where it's completely mechanical again, but you do need to be aware of what you are doing. Which rule are you applying? The question for step number 4 is the fair value gap out in the third step a breakaway gap or an FVG? The first question we ask ourselves, if it is a breakaway gap, is there a discount array that is higher than this fair value gap right there? No, actually not, because the breaker sitting right there is below the fair value gap or halfway through the fair value gap. So the fair value gap, the opening of this fair value gap is higher than the breaker we have right there. Perfect. That might indicate that this is a fair value gap. Then the second step we need to go over is understanding if the third candle right here that actually confirms the fair value gap closes above the second candle's high, meaning this high right there. And I'll show you the example of a breakaway gap right there in the next one on Australian dollar CHF. But here, this does not close above this second candle high, meaning that this is not a breakaway gap based on the two questions that we had. Is there a discount array above this fair value gap? Does the third candle close above the second candle high right there? Of course, in a bearish situation, it would be, does the third candle close below the second candle low? For example, this one right here. This is a breakaway gap. Why? Because this right here, the third candle closes below the second candle low. So when we go over those two questions and we come to the conclusion that it is not a breakaway gap, then it means it is an FVG, a fair value gap. In that case, you want to enter off of the fair value gap right there. Covering again the lows, you can cover the bodies, you can also cover the swing lows right there. Targeting a 1, 2, 2. And the most important part, of course, understanding that we can enter right there off of the fair value gap itself. Because since it is not a breakaway gap, we do expect a retracement back into it. All right, here we are on the third example, Australian dollar CHF, and showing you the last variation possible. But before we dive into that third and that last variation, we need to understand again the PD ray, the discount array, that 4-hour fair value gap right there. Targeting eventually those highs. Then we have the choice. We can go into the 15-minute or the 5-minute. For this particular example, I want to go into the 5-minute to show you the third variation. All right, on the 5-minute, we see again the volatility, the momentum, the intention going into the discount array. Once we then are close to the discount array, this fair value gap already shows that intention, shows the manipulation. It becomes even better because we see right there that we do not create a new 5-minute fair value gap lower off this previous 5-minute fair value gap. Absolutely perfect. That shows that again, like on USDJPY, shows that there's more bullish intention currently in the market. So when we then create a bullish fair value gap right there, that is exactly what we would want to see. But this bullish fair value gap right there, the third step, the fair value gap out, is not enough because now we have aligned the time frames differently. And to be honest, this is my preferred entry variation right here. I always like to get the double confirmation instead of the sharp turn we talked about earlier on Bitcoin and on USDJPY. And the reason for that, so if you've made it to the last example, then you're getting golden nuggets, because the reason for that is when we actually retrace into a discount array right there. That is exactly what you would want to see. So the first fair value gap higher right there, you would want to see a retracement, a retracement into any discount array that creates a new fair value gap higher right here. That is exactly what you would want to see. The reason for that is because this now shows that there was a discount array holding, meaning that all this time right here, we have been bearish. Well, perfectly bearish, no, but we have been bearish right there, which means that premium arrays were most likely holding. The premium arrays were in charge of the market. They were in control. So to show that that control is actually shifting, we can only see that by discount arrays now holding. And creating that first fair value gap, retracing into a discount array, creating a new fair value gap higher, that shows that discount arrays are now holding, which means that is the perfect confirmation that you actually can take an entry right there. And this is exactly how you want to go over that entry pattern as well if you go for the lower time frame. So for example, the 1 hour with the 1 minute, then you would want to see something similar to this, where I mentioned two fair value gaps higher. The first fair value gap, ideally a retracement into this array, and then a new fair value gap higher off of that. In the fourth step, we ask ourselves again, is this right there then the breakaway gap? Is that a breakaway gap? So we're not talking about the first fair value gap out right there. We're talking about this fair value gap right there after. Is that a breakaway gap? Well, is there a discount array above this fair value gap sitting right there? No, because there's nothing overlapping right there with the fair value gap. Meaning, yes, you do have those wicks, but these wicks are not valid because they are not overlapping with a fair value gap. So you have this order block right here and even this order block, but that is below the fair value gap. All right, so that's the first indication that that might actually be an FVG. But we need to go over the second question. And the second question is, when we created that fair value gap right there that we are looking to enter off of, do we close above the second candle high? Yes, we do, indicating that that might be a breakaway gap. So what do we do in this situation? How do we enter this when the third candle closes above the second candle high? This is where you use the last variation, which is not entering on the discount rate that was there above the fair value gap, not entering off the FVG itself, but you enter off the creation of the fair value gap itself, meaning this fair value gap gets created once this third candle closes right there. That is exactly your entry. This is a technique that I like to use a lot because here price might never retrace into those breakaway gaps right there, might never retrace into any discount array and might just take off. So if we've been waiting for all that time to come into that discount array to then show the entry pattern, I do not want to miss that move. I want to be a part of that. I want to make some money right there. Targeting the 1 to 2, absolutely perfect. This is the last variation for that fourth step. Again, for that fourth step, we have 3 different variations. You either in the breakaway gap, it's a breakaway gap because there's a discount array above the fair value gap, like we saw with Bitcoin. And when that is the case, you enter on the discount array that is above the fair value gap right there. But let's say that isn't the case, and we do have a third candle closing above the second candle high, then we enter off the creation of the fair value gap like we're seeing here on Australian dollar CHF. But if it isn't a breakaway gap right there, and there is no discount array above the fair value gap, and the third candle right there does not close above the second candle high, then like USDJPY, we enter off of the fair value gap itself, and the entry can actually be in the fair value gap itself right there. So from step 1 to the last step, step 4, there is a step-by-step manner. There's a mechanical guide right there in order for me to get to my entry model. With the guide right there, making it simple. Of course, it's something you need to get used to. Don't worry about that. You can get used to this. Give it some time to get used to it as well. And of course, there's also cases where, for example, here on USDJPY, when we do not close above that second candle high, we do not trade into the fair value gap. And of course, this could also happen where we do have a discount array above the fair value gap, or what we establish to be a breakaway gap right there, and we do trade back into a breakaway gap to then continue higher. Again, that's not the point. That is going to happen. This is not 100%. Nothing in trading is 100% guaranteed, but it's all about probabilities. And what we have done here is we have outlined the highest probability thing for you to actually capitalize on it, no matter what happens right there. The highest probability thing for this to happen is that it doesn't trade back into that fair value gap. It's all about probabilities. That's very important to remember. All right, so if you do want my help to fully understand this and see if you actually fully understood it as well, then feel free to send your case studies to my Twitter, Arjo.io. It's, by the way, the only Twitter that I have. So please don't get scammed by any weird accounts. Feel free to send me your case study right there. Just post it publicly, give me a tag right there, and I can go over it as well. Or on Instagram, of course, through stories, for example. And then I'll see you at the next one. All right, perfect. Thank you.